Imagine looking at a company whose bank account just, exploded by over 800%.
I mean, you probably want to buy in immediately.
Right. You think it's a sure thing. But what if, upon closer inspection, you notice the CEO and the general counsel quietly rushing for the exits at the exact same time?
Yeah, that changes the math completely.
Exactly. So today, we are tearing apart this massive paradox. We're looking at Quantum Computing Inc., ticker symbol QUBT.
A super interesting one.
It really is. The big question for you, the listener, is this. Are you looking at a deeply undervalued, hidden gem that's sitting on a mountain of cash? Or is this just a classic value trap meticulously designed to crush retail traders?
And that is really the defining tension surrounding the stock today, April 20th, 2026.
Because the signals are just all over the place.
They really are. You have this fascinating collision of data points. I mean, we're looking at a mid-cap, highly volatile player in the photonics-based quantum hardware space.
Which is a mouthful on its own.
Right. It's a complex sector. But the fundamental data screams one thing, the market momentum implies another, and then the internal corporate actions suggest something else entirely.
So let's ground this in the immediate reality of the tape. Like, what is the stock actually doing today?
Good place to start.
In early trading today, QUBT is sitting at $9.21.
Okay.
That's down about 2.44% on the day. And just for some context on the sheer volatility we're dealing with here, they're sitting comfortably above their 52-week low.
Which was what, 5-something?
Yeah, $5.76. Huh. But they have a massive, just grueling climb ahead if they ever want to touch that 52-week high again.
Oh, yeah, that peak was way up there.
$25.84. So huge range.
It's a massive range. But, the current price action is actually a bit deceiving if you don't look at the catalyst behind it.
What do you mean?
Well, QUBT recently enjoyed this significant surge in price, but we have to understand the mechanics of that move. It wasn't driven by, like, an internal breakthrough.
Or a massive new contract or anything.
Exactly. The broader market just experienced this sympathy rally, and it was all driven by NVIDIA announcing new quantum infrastructure investments.
The NVIDIA halo effect.
Right. When a behemoth like NVIDIA signals interest in an emerging sector, algorithmic trading systems, and, retail investors, they immediately scan the market for anything with the word quantum in the name.
A rising tide lifts all boats, basically.
Exactly. So QUBT's boat got lifted.
So the technicals right now, they show a stock kind of gasping for air on a relief bounce.
Yeah, that's a good way to put it.
But a stock doesn't bounce in a vacuum, right?
Yeah.
Let's look at the actual technical levels where QET is living right now. What's the data telling us about the immediate floor and ceiling?
So, breaking down the technical landscape, we see immediate support holding right around that $9.10 level.
Okay, so that's the short-term floor.
Right. And if the selling pressure breaks that line, the 50-day moving average provides a deeper, much stronger floor at $8.16.
So that's where buyers might step in.
Exactly. But the real problem for any bullish trader is looking upward. The resistance is just incredibly dense.
Like trying to punch through a brick wall.
Yeah, pretty much. QUBT faces immediate hurdles just to grind through the 970 to 990 zone.
And it gets worse above that.
Oh, it gets much worse. Looming just above that is the 100-day moving average at $9.61. And then, this is the big one, you hit this massive ceiling, the 200-day moving average sitting ominously at $13.20.
Let's pause on those moving averages for a second, because the cross currents here are, they are the perfect trap for an inexperienced trader.
They really are. It looks so confusing on a chart.
Because the short-term indicators, like the 5-day, the 20-day, and the 50-day averages, they're all pointing up.
Right.
So visually, if you just glance at it, that looks like a breakout. But the long-term averages, the 100 and 200-day, are pointing dead down.
Which is the classic bear market bounce setup.
Exactly. I like to think of the 200-day moving average like a massive cruise ship.
Okay, I like this.
And the short-term 5-day average is like a speedboat buzzing around it.
Right, right.
That speedboat can change direction instantly. It can point up, tricking you into thinking the whole momentum is shifted. But that massive cruise ship, it's still slowly, inevitably drifting downward.
It takes forever to turn a ship like that around.
Exactly. It takes immense, sustained fundamental energy to turn a 200-day moving average.
That analogy perfectly illustrates the trap of the Daily Relative Strength Index, or the RSI.
What's the RSI looking like right now?
Well, right now, QUBT's daily RSI is sitting at 68.6. 0.06.
Which is getting up there.
It is. For anyone unfamiliar, the RSI measures the speed and magnitude of recent price changes. And an RSI approaching 70 is, well, it's critical.
Yeah, 70 is usually the danger zone.
Exactly. In the psychology of the market, a 70 usually means the last eager buyer has already bought.
Right.
Furthermore, when an asset crosses that 70 threshold into overbought territory, it frequently triggers automatic sell signals on like a ton of algorithmic trading platforms.
And those algorithms, they do not care about the company's story.
Not at all.
They just see a math equation telling them to distribute shares and take profits.
Precisely. The consensus among technical analysts right now is that this current price action is merely a relief bounce within a larger long-term descending structure.
So it's not a true reversal yet.
No, not technically. The short-term momentum is positive, but it's already showing severe signs of exhaustion. The stock is essentially just catching its breath after a long period of weakness.
Subsidized entirely by NVIDIA's halo effect.
Exactly.
Okay, so if the technicals only tell us how people are trading, we have to transition to the financials to understand, why they're willing to take these bets in the first place.
Right, what's actually under the hood?
Yeah, and this is where QUBT's story fundamentally shifts. We have to talk about the $750 million private placement.
That was a massive, massive deal.
It really was. That single capital raise completely mutated the financial DNA of this company over the past year.
Yeah, mutated is definitely the operative word there. I mean, to raise that kind of capital, a mid-cap company has to execute a massive secondary offering.
Right, they didn't just go to the bank and get a loan.
No, not at all. They sold institutional investors a massive stake in the company.
And the resulting balance sheet looks like an absolute fortress. Let's walk through these staggering year-over-year numbers.
They are pretty wild.
Cash and cash equivalents skyrocketed 834%.
Wow.
Yeah, up to $737.9 million. Total assets grew 954%, swelling to $1.6 billion.
That's billion with a B.
Billion with a B. And their debt, it's practically non-existent. They're carrying a mere $1.8 million in lease obligations.
Which is nothing for a company that size.
Exactly. So from a pure asset perspective, they have incredible staying power.
They do, but, a balance sheet only tells you what a company has accumulated.
Right.
The income statement tells you what the company actually does with those assets. And when we look at QUBT's actual business performance for the full fiscal year of 2020,
oh boy, here we go.
Yeah, the narrative completely fractures. Total revenue for the entire year was only $682,000.
Let me just stop you there because that disconnect is jarring.
It's massive.
Having $1.6 billion in assets, but making less than $700K in revenue? It's like owning a $1 billion state-of-the-art tech campus completely debt-free, but trying to pay for the property taxes by operating a single lemonade stand in the front lobby.
That is painfully accurate.
How does the market justify that kind of disparity?
Well, they justify it through the lens of early-stage venture capital mechanics, but, applied to public markets.
Okay, so valuing the potential, not the present.
Exactly. But we should acknowledge the improvements in those income metrics. I mean, that $682,000 in revenue, that is actually an 82.8% increase year over year.
So they are growing, technically.
Technically, yes. And more importantly, they aggressively trimmed their net losses. They dropped from a brutal $68.5 million loss down to an $18.67 million loss.
Okay, that's a real improvement.
It is. Their earnings per share improved accordingly, too, moving from negative 73 cents to negative 11 cents.
Trimming losses is great, obviously. But we are still talking about microscopic revenue generation relative to the cash they're holding.
Right.
Is there any sign that this lemonade stand is actually evolving into a real business?
Actually, yes. There is a vital silver lining buried in the Q4 2025 data.
Oh, what did they do?
They brought in $198,000 in that final quarter alone. And the key detail here is the source. That revenue was driven specifically by their Fab 1 facility.
Ah, their photonics manufacturing plant.
Yes. And in the quantum sector, the debate is always between supercooled massive quantum computers versus photonics.
Right, which use particles of light and can operate closer to room temperature.
Exactly. Much more practical in some ways. So that $198,000 from Fab 1, it signals a critical transition. QUBT is no longer just a pure R&D science experiment surviving on, consulting fees or government grants.
They're actually selling something.
They are actively engaging in early hardware commercialization. Somebody, somewhere, actually cut a check for their physical technology.
That proof of concept is definitely in the bullish anchor.
For sure.
But if you're holding this stock, or, thinking about buying the dip, you absolutely cannot ignore the immense cost of building that fortress balance sheet.
Oh, the cost was huge.
I want to construct the bear case here because this is exactly the kind of setup that traps retail traders.
Yeah.
The ones who only read the headlines about a $750 million war chest.
Yeah, you have to look deeper.
Let's talk about the valuation trap first. QBT is currently trading at a price-to-sales ratio of over 700 times relative to its industry.
That metric is just staggering.
It's absurd.
A price-to-sales ratio of 700x means investors are paying $700 for every single dollar of sales the company currently makes.
Which means you are not pricing in current reality at all.
No, you're pricing in a decade of flawless execution. It leaves absolutely zero margin for error in their manufacturing or their sales pipeline.
And then there's the dilution.
Yeah, the dilution is brutal.
Because that $750 million didn't just materialize out of thin air.
The company had to print millions of new shares to sell to those private investors.
Outstanding shares nearly doubled in a single year. They ballooned from 129 million up to 224 million.
Let's explain the physical mechanics of that dilution for the listener, because it's so important.
Please do.
Imagine you owned a slice of a pizza. Suddenly, management takes the pizza back, cuts it into twice as many pieces, and hands you back a slice.
A much smaller slice.
Exactly. The overall pizza might be slightly larger because of the new cash, but your individual slice, your voting power, and your claim to future earnings just got cut in half.
That hurts.
And those institutional investors bought into that private placement at a negotiated price, which severely devalued the retail shares already floating in the open market.
And then you add the cash burn to that equation.
Right.
The company's burning through about $37 million annually.
It's a lot of cash going out the door.
And they openly state that profitability isn't even on the radar until 2028 or 2029 at the earliest.
Which means that $737 million isn't a permanent fortress, it's a ticking clock.
A clock that forces management into very specific behaviors.
Yes.
Which brings up the most glaring red flag in this entire deep dive.
The insider selling.
Exactly. If you want to know whether a stock is a hidden gem or a value trap, look at what the people steering the ship are doing with their own money.
Always follow the money.
While April 2026 saw some direct stock grants to directors, which, that's standard corporate compensation, the real story is the heavy selling that took place in late 2025 and early 2026.
It was aggressive.
The CEO, Yuping Huang, dumped roughly $14.4 million in shares in September 2025.
Wow.
Then the general counsel sold $614,000 in March 2026 after exercising options.
We really have to look at the psychology and the market signaling of those insider moves.
Yeah, what does that tell you?
Well, it's one thing for executives to sell a few shares to cover tax obligations or just to, diversify their portfolios a bit.
Sure, that happens all the time.
But when the CEO cashes out to the tune of $14.4 million, right around the time the stock is being massively diluted for retail investors, the optics are just catastrophic.
It's estate generation money. They're securing generational wealth for themselves while asking retail investors to hold the bag and wait for a 2028 commercialization phase.
Exactly.
If the CEO truly believed that the $750 million cash injection was going to propel the stock to new heights, why pull $14 million off the table right before the supposed growth phase?
Right. The signaling suggests that management viewed the temporary price spikes as a ceiling, not a floor.
Which is terrifying if you're buying at those levels.
Exactly. When the people with the most intimate, unfiltered knowledge of the company's daily engineering struggles and their sales pipeline are aggressively taking profits, retail traders need to be highly cautious about buying into the hype.
So we are looking at two massive, opposing tectonic plates here.
A real tug-of-war.
On one side, you have a $750 million cash runway and early hardware sales. On the other side, you have an astronomical 700x valuation, brutal shareholder dilution, and multi-million-dollar insider selling.
It's a lot to weigh.
So let's synthesize this. Provide the ultimate bull versus bear outlook for our listeners who are trying to model this stock. Let's start with the bull case.
Okay, so the bull case, the best case recovery scenario, is entirely predicated on survival and strategic expansion.
Survival being key.
Yes. In the deep tech startup world, cash is oxygen, and that $737 million runway entirely eliminates the immediate risk of bankruptcy.
Which is huge.
It is. They don't have to panic about payroll tomorrow. Furthermore, they are deploying that capital strategically. They recently acquired Luminar, Semi, and QUBT.
But what do those acquisitions actually do for the bottom line, though?
Well, they instantly expand QUBT's intellectual property and their engineering capacity. QUBT, for example, provides advanced cryptographic security layers.
Oh, okay. So secure.
Right, which is a crucial selling point when you're trying to market quantum machines to government or enterprise clients.
Makes sense.
These acquisitions give them the specific tools needed to scale that Fab 1 facility. So the bull case requires QUBT to leverage that new IP to rapidly scale the $198,000 they made in Q4.
Turn that 198K into millions.
Exactly. If they secure significant orders for their thin film lithium niobate chips, the TFLN chips, they validate the entire business model.
And we should clarify the importance of those TFLN chips. They're essentially the optic nerve for these quantum computers.
That's a great way to describe them.
They process light signals at insanely high speeds while consuming very little power. If QUBT can lock in enterprise orders for these chips, they aren't just selling a niche product, they are selling the foundational plumbing for the whole photonics industry.
Which is a massive market.
But what happens if those orders don't materialize? What is the worst-case continuation?
The bear case is simply gravity taking over. If they cannot scale that hardware revenue at an aggressive exponential rate, that 700x valuation will just crash under its own weight.
The market won't support it.
The market simply will not sustain a billion-dollar market cap for a company generating sub-million-dollar revenues once that NVIDIA halo effect wears off.
Right. And as that happens,
the $37 million annual cash burn will act like a slow leak in their fortress. And from a technical standpoint, that long-term descending trend dictated by the 200-day moving average. It will resume with a vengeance, trapping anyone who bought the recent relief bounce.
Man. And the professional analysts seem just as divided as the data itself.
They're all over the place.
Wall Street consensus is currently straddling the fence with a hold or moderate buy rating. But the actual price targets are wildly fractured.
It's almost comical.
The average target sits at $17.40, which implies an enormous 84% upside from where we are trading today.
Right.
However, Ascendian Capital is modeling a target all the way up at $27, while Cantor Fitzgerald anchors the low end at a mere $10.
That massive $17 spread tells you everything you need to know about the state of quantum financial modeling right now.
Nobody knows anything for sure.
Basically. The analysts are essentially running discounted cash flow models out to 2030 or 2035, and the error bars on the terminal value of quantum hardware are just massive.
Small changes make huge ripples.
Exactly. A minor tweak in an analyst's assumption about when QUBT achieves mass production drastically swings the target price from $10 all the way to $27.
So how should an observer frame the timeline for this stock?
In the short term, expect volatile sideways consolidation.
Just bouncing around.
Yeah, the stock will likely bounce violently between that $9.10 support and the $9.70 resistance as the market digests the recent sector-wide gains.
And it'll react to any news.
It will be hypersensitive to the news cycle. A single press release announcing a verified order for those TFLN chips could trigger an algorithmic breakout.
But on the flip side,
conversely, a missed deadline could send it testing that $8.16 moving average really fast.
and what about the long-term perspective?
Long-term, the narrative is entirely about execution. QUBT must scale its revenue to meet a staggering $17.3 million forecast by the year 2028.
17.3 million.
That is the magic number. If they hit it, the current valuation begins to look rational. If they miss it, the market will aggressively reprice the stock downward. They have to transition from selling potential to actually selling hardware.
Which brings us to the core of today's analysis. We want to clearly remind you, our listener, that this deep dive is a natural human debate exploring the factual, publicly available landscape of QUBT.
Always do your homework.
Absolutely none of this should be taken as financial advice. Do your own research and consult a professional before trading highly volatile mid-cap stocks.
The data presents a very complex puzzle.
It is the ultimate paradox. QUBT boasts a rock-solid balance sheet, but it was purchased through massive dilution that basically halved the retail investor's share of the pie. They're riding incredible sector momentum driven by AI and quantum infrastructure narratives, but they're simultaneously battling heavy technical resistance and multi-million-dollar insider selling.
It's a company occupying a billion-dollar footprint while generating a lemonade stand's income.
Perfectly said.
Yeah.
Which leaves you with a final provocative question to mull over.
We know QUBT's survival depends on hitting that 17.3 million revenue target by 2028.
Right.
But in the hyper-competitive race for quantum dominance, does a $750 million war chest even matter if massively funded competitors like IONQ or RGTI manage to solve the hardware commercialization puzzle first?
Oh, that's a great point.
Can money actually buy time in a sector that is evolving at quantum speed?
That is the ultimate test for QUBT. Are you looking at a hidden gem quietly building the plumbing of the future, or a value trap just waiting to spring? Keep your eyes on the data.
It's going to be a wild ride.
And if you're joining us on video today, drop a comment below. We want to know, are you buying the fortress or avoiding the trap? Like the video and subscribe to our YouTube channel so you never miss a deep dive.